The BRICS, they're so yesterday. Instead of Brazil, Russia, India, and China, invest in Turkey, Indonesia, and what was once known as a sick man of Asia, the Philippines. So says Morgan Stanley Investment Management's global head of emerging markets equities, Ruchir Sharma. He calls them the next breakout nations, countries that can sustain fast growth and meet or beat expectations. His thesis rests on the expectations game.
The way that you define breakout nations is that they need to beat expectations. And they need to do much better than their own sort of peer group in terms of, their own income class. Now, the problem that some of these markets have is that expectations of them came to be too high. So if China, the parallel that I use is like Usain Bolt, which is that when China sort of goes out there, you expect it to sprint and to win by a huge distance.
Compare that to Turkey, Indonesia, and the Philippines, a group I'm going to christen the TIP. Sharma says the TIPs carry reasonable expectations. He calculates that based on their average per capita incomes, Indonesia and the Philippines need to grow 5% or more, for Turkey at least 4%. According to the IMF, Indonesia and the Philippines will miss those targets this year and next, but should hit them by 2017. Turkey, by contrast, is already above those targets and could rev up even more. So you might want to pick up Turkey before it breaks out and doubles its growth rate by 2017. Besides, according to StarMine data, it's relatively cheap. By contrast, the Philippines and Indonesia trade at more than 15 times earnings. Only iShares sells funds focused on Turkey and the Philippines. Its Turkey fund scores well for its strong returns and low fees, but those returns are volatile. For Indonesia, Lipper recommends Market Vector's Indonesia Index ETF for its strong, steady returns and low fees. Finally, the guru of emerging markets, Franklin Templeton's Mark Mobius, says he agrees with Sharma's tip picks, but says frontier markets offer much better breakout potential. We'll explore that in a future segment.